Joining me now to kick off the week, Ken Mahoney, CEO of Mahoney Asset Management. Ken, so good to have you. Thanks so much for being here.
Thanks for having me.
So stocks are bouncing back today after snapping a 9-week winning streak. For investors who didn't buy Friday's weakness, did they already miss their chance, Ken, or do you think we'll get another opportunity?
I think we have another opportunity. We got to watch that volatility index known as the VIX. And for a viewing audience, that kind of shows, how much complacency is out there, how much fear, greed, that type of stuff. It was a 40% on Friday. That's top 10 of all time. So, yeah, we bounced back a little bit today. We'll see what happens next. But, we've always kind of more about tactical, putting bids below the market, having those awful days picking up stock, having those parabolic days on the other side, putting out some offers. So we kind of create our own alpha around some of this volatility.
Well, headlines made it seem like potentially the start of something bigger. But do you look at Friday's weakness as simply profit taking after a huge run higher, or did it reveal a real vulnerability in the market that we have to be careful of?
But I think, the AI trade got very crowded. We got to one side of the ship, so to speak, and we've been there also. And the market's a bronco. It's going to try to kick you off. It's not supposed to be easy like it was for those 9 weeks. Trouble ahead? I don't know. I mean, the biggest trouble ahead we see is the concern about midterm elections. And it's always hard to figure out when the market's going to wake up and say, ooh, we don't like that event. So I think, to be overly bullish or bearish here, that's tough to make a case. But if I had to pick one or the other, I would say it'd be more of a bullish because of the earnings, the staggering earnings that we're seeing. Even off the earnings cycle, we saw Snowflake and Dell, and these analysts keep scrambling to keep up with these guidance increases and so forth. So if I had to kind of bet one or the other, yeah, we still are pretty bullish here. But it also shows that risk happens fast, really fast. And, when it comes to volatility, you have to kind of expect it and play that in. You can make volatility your friend or your foe.
So you talked about watching the VIX. What specifically are you watching as warning signs for potentially more challenging times ahead?
Well, we have to look at the yield curve, right? So basically, it was a ping pong. The set off on Friday. Good news: 170-some thousand new jobs created. Most of our clients are like, well, that's good news, isn't it? Yes and no, and probably a little bit too heavy because there's no way the Fed's going to be cutting rates, and then the futures market showing a 2/3 chance of a rate hike. So you get good numbers in the economy, which, by the way, be careful what you wish for. I don't think we want a whole bunch of soft data points for the labor market. But you have this yields going up, inflation expectations going up. You have a hot job market. That's what spooks the market. That's what kind of led, I believe, Friday to this cascading lower throughout the entire session.
I'm curious, you mentioned your clients. How many nervous client calls did you get on Friday, and what were they most worried about, or were they looking at it as a buying opportunity? What did you say?
Yeah, it was rather mixed. I was kind of surprised to get calls panicky. I mean, we had 9 weeks of gain to have one off day. It's like, to me, it doesn't change the trend, but it is surprising. It's sometimes the regular clients, the usual clients that when they see see something in the market that they get upset with, they'll call. But others, yeah, you're right. They're looking for some AI sales or some semiconductor sales, and some were buying in the market, some were putting bids below the market. But it was kind of mixed. It was kind of funny to watch the same old people typically that called in when they get really nervous about the market.
What should investors be doing right now for the everyday retail investor who saw what can happen on Friday, but saw that the market's already bouncing back, the dip is already being bought? What should they do from here?
Well, I think they should start with that 30,000 feet view asset allocation mix. And we say that a lot. We don't have bonds in our allocation. We haven't had since the beginning of the year. Again, if you need income, that's different. We're talking about total return. We're about 1/3 in cash, about 2/3 in equity. The 2/3 in equity, mostly large cap growth. We're in that space we like. The 1/3 sounds like a lot, but it's not, because, you also have had some good gains. You're supposed to be able tactically to take some off the table periodically, like we do. You call it rebalancing or however you want to call it. And having about 1/3 right now gives you some flexibility that, if you're 100% invested in this market and it comes down, you don't have any power draw. You have nothing to work with. So, we're in the mind that we've had this huge run, probably have to work a little bit off. Yes, we have a bounce today, intraday. We'll see where we close. but it's still got some shoving to do here. I mean, Nasdaq was down 1,100 points, and as I'm speaking right now, I think down. I mean, up about 300 or 400 points. So about a third of it came back, but still, it still has some work to do because again, that just spooked everybody really quickly. How fast it can change.
So, talk to us about where you're going to put that third of the cash part of your portfolio to work. What are you waiting for? What's on your list?
Well, so our shop, one of our favorites is still Apple, and I know some people kind of scratch their head and say Apple. Well, I think they did a good job not being a hyperscaler, spending hundreds of billions of dollars. Kind of let the first go through and kind of watch that. I do think they're going to figure out the Siri thing at some point, and maybe the Gemini from Google. But what really fascinates us about Apple, true and true, there are nearly 2.5 billion devices out there. You can really monetize that, like a little $10 a month here and there, and it's an extra 25, $30 billion dropping to the bottom line. So, Apple is only a few points away from its all-time high. You could put bids below the market. Again, we like it because they have a wide moat, and certainly with 2.4 to 2.5 billion devices out there, you can do a lot, and they've saved a lot of money not jumping into the AI pool. Again, we saw what Google spent last week and what they're spending, what Facebook or Meta may be spending. You're seeing a lot of companies like Amazon, pretty much all the free cash flow is going into CapEx, and Apple sitting on the outside may look like they were losers in this initially, letting the first movers do their bit, and now here's Apple, with a lot of cash and a lot of opportunity.
So just quickly, wait for a pullback in Apple, or you would buy it up 15% year to date?
Yeah, you could buy some here at Nibble. Again, it's kind of dollar cost average. I know a lot of clients or investors get stuck with the price. Oh, I bought IBM at 310. Why not give yourself 3 or 4 stabs at it? So if you bought Apple in the beginning of the year and you're up 15%, and we had a downturn, you could always add to it. My point is that you shouldn't just live and die with one price. You should be able to incremental coming into a stock of your favorite ones, incrementally coming out if it goes parabolic or nearly parabolic. So for Apple, even though it's up 15% year to date, almost double that of the S&P 500, it's also telling you it's one of the leading stocks, even though it's Apple. In other words, most investors are looking for some small mid cap, more sexier names, I would say, than Apple. But again, you have to like the new management. They're more visionary, and I think it's going to work out just fine this year for them.
Okay, what else is on your shopping list? If someone has some cash to work with, what should they be buying?
So we still like the picks and shovels. It's kind of the picks and shovels of the 1990s, right? The picks and shovels of this move to us is Veritiv, and it's GEV. GEV is the spinoff of General Electric. They do a lot in the ways to find alternative powers. And then the Veritiv actually tries to cool down the system. So if you think about all the money that's being spent, we would really like to own the infrastructure to the tech, but also, if you kind of look from 30,000 feet, you're going to need companies like them to cool off these data centers, to get more generators, from GEV. So those are two names we really like. Both are recently added to the S&P 500. Both are up quite a bit, even after Friday's sell-off. But that's how we like to play the AI, is really through this infrastructure play.
So far we've only talked about tech. Is that indicative of how your portfolios are structured? Still very tech heavy, or is now the time to diversify?
Yeah, that's a really good question. So we do own some JP Morgan. JP Morgan, it seems like a good support level, 300. It hits it and bounces up. They clear about $1 trillion worth of every day that goes back for Jamie Dimon, best in class. So we're trying to bring down the beta a little bit for portfolios that trades like around a 0.6 beta. Walmart actually took it on the chin, the earnings season, but we also see them as kind of a poster child for using the technology, using it for inventory, using it for logistics. I mean, they do a great job with that, and they should be rewarded for the money they've been putting into the infrastructure. Again, but we are mostly large cap growth. We are growth managers, but we also recognize sometimes we need to soften or lower the volatility in the portfolio so the clients stay with it longer. And those are some of the names that we have outside of tech. But they're very specific. We don't own airlines, autos, retailers. We tend to kind of stick in our lane. Even though that lane is bumpy and it's volatile, we think that's where investors get rewarded.
You mentioned at the top that there's some areas of the market that were getting a bit too crowded. What areas still look crowded to you?
Yeah, I guess, it's like that .com days. You have XYZ company, they call themselves XYZ.com. We're starting to see some of that frothiness. We're starting to see just be associated with the name, just an AI name attached to the company, and the multiples go higher. So you're seeing that in a lot of different areas. But the interesting thing about this, though, is we have a rotation. We've had rotations, but it's not out of the market. It's mostly rotation under technology, from drones one week, quantum technology another week, semiconductors another week. So they really don't get a big chance to get bubbles like everybody's looking for, because the rotation that's happening under tech has been so severe. So it's crazy, like how they take turns. So we don't see anything that the bubble bursting or any of those type of things are out there. This business to business environment is amazing, the amount of money being spent. And again, analysts cannot even keep up with all the upgrades and all the guidance numbers that are going up much higher.
How much of that money do you think is going to rotate into some of these massive IPOs that we're expected to see? SpaceX this week, potentially Anthropic after, OpenAI. And how are you talking to your clients about those names, when to get in, how much to allocate?
Yeah, for SpaceX, again, unless you're in like Musk and Goldman Sachs and insiders, they have a good price. When it trades publicly, we're shying away from that. We'd rather see a month or two. We're both kind of eclectic. We're fundamentalists, and we're also technicians to that extent. It doesn't have a track record technically, obviously, because it hasn't traded there yet. Even though it's so exciting, but at the same token, we're advising our clients, especially in the first day, don't go anywhere near it. Let it settle around. I suspect a month or two will show some type of pattern. If the pattern is in an upward slope, that's a better time, even if you have to pay more for it. But it's really it's really like kind of Russian roulette to buy the open on Friday, especially if you think to transfer wealth there. Transferring liquidity into retail hands generally doesn't really work out too well for retail.
Okay, all right. A good time to pivot to our rapid fire round. Before we get to this or that, we're going to do a quick 60-second portfolio. You're going to build me a portfolio from the top down. Only quick responses. Are you ready?
Ready.
All right, let's start with allocation. How much is in stocks? How much is in everything else?
So 2/3 in stocks, 1/3 cash, no bonds.
No crypto?
No crypto.
Of the 2/3 in stocks, what's the first sector you're overweighting?
Well, it'd be Apple. You call it consumer electronics. You can call it what you want to call it, Apple these days. They have a lot of different verticals, but I would say Apple.
One sector you're avoiding?
One sector we're avoiding. There's a couple of sectors we're avoiding. I would say we're avoiding airlines, autos, retailers.
What's one must-own stock in this portfolio that's not Apple?
One that's not, well, we could say Micron. Though again, we've been shaving profits. That's going down. But again, their earnings, it was almost like NVIDIA a few years ago, where the earnings and the guidance were just parabolic. And Micron, again, still trading at a 4P around 15, even with their growth rate.
Where do international stocks fit into this portfolio, if at all?
None. Though, again, we get that through our companies, U.S. companies that are all around the world in U.S. dollars. That's what we like about it.
What's the one position you'd be adding to on weakness?
Well, going back to Apple, GEV, Veritef, VRT.
What's the biggest risk to this portfolio?
I think like everything else, higher interest rates, higher inflation, I think that from the top down that hit every sector, should that raise its ugly head, higher inflation translating to higher interest rates, more competition to stocks.
All right. Great. And now time to pivot to our rapid fire game of this or that. More quick questions, more quick
Okay,
answers. Are you ready, Ken?
I'm ready.
All right, here we go. Stocks by year end, higher or lower from here?
Higher.
How much higher?
Oh, indexes maybe another 3 to 5%, but we like to think this is not a stock market; it's a market of stocks. In that growth lane, in that left lane, still 10 to 15% upside.
Buy the dip or chase the momentum?
Buy the dip.
Buy any pullback or wait for a bigger flush?
Yeah, again, so we buy the dip. Looking at the VIX, if the VIX is all of a sudden getting kind of panicky, we would pull that back a little bit, or if that change of direction.
Mega cap tech or the next generation of AI winners?
So we have a mix there. I would say about 3/4 is still in that mega, and about a quarter of the newcomers coming up.
Name one of the newcomers that you'd buy here.
Eesh. So again, that would be Veritaf, or GEV, the General Electric spinoff. There's so many up and comers. You could buy a basket of them. DRAM, if you really want to get more memory instead of trying to buy individual stocks. ETF, DRAM.
AI trade, overhyped or underhyped?
That's a tough one because I don't know. The multiples that could come out of this is something we haven't seen. So I'm going to go with it's not hyped enough. It really is transformative. It really is a total disruptor. Yeah, so I'll go with that one.
Early innings or middle innings for AI?
Early innings technology wise and how it could be used, but middle innings valuations, right? It's not second or third inning anymore after a lot of these stocks have quadrupled or doubled. So that's the way we look at it.
AI infrastructure or AI software?
AI infrastructure.
One AI software stock you'd add here?
AI software stock? I would say Google. It's down quite a bit. The Gemini is a really strong AI.
Okay. NVIDIA or Micron?
Micron.
Broadcom or AMD?
AMD.
Another non-tech stock you like here that's not JP Morgan?
What we say, Walmart. It's hard. We have some utilities, Southern Company. Again, the play of both demand and extra demand because of the data centers.
What's one stock investors are sleeping on?
I'm sorry. What do you mean by sleeping on?
Or just like one under the radar play that isn't getting enough love?
I guess that's Microsoft. I mean, the verticals from cloud to gaming to you name it. I mean, they have it all, and yet the stock is really stuck. We have it also. It's tough to watch and meander, especially when some of the parts are greater than the whole. But I think that's one. It could be a sleeper. If someday we wake up and give them better kudos, the stock could get going. But again, it's tough. It's a tough stock to hold. I'll tell you that.
Bigger market risk, geopolitics or valuations?
I'm going to go with geopolitical concerns because it seems like the earnings are supporting this move. In fact, actually, you have 15 to 20% earnings growth year over year. So yeah, geopolitical, and it's something probably not on our bingo card, like Iran probably wasn't on our bingo card coming into this year.
One word to describe how you're feeling about the market right now.
Confident.
Ken Mahoney, CEO, Mahoney Asset Management. Thank you so much for your picks and your insights. Really appreciate it.
Thank you. Thanks for having me.
If you enjoyed this Street Talk, check out our full interview with Sonali Basak, where she lays out the unloved sector that she thinks Wall Street should rotate into. It's not technology.